My name is Leigh Drogen. I'm the founder and CEO of a company called Estimize. I'm going to tell a little bit of a story about how we solved an interesting problem around what people like to call the chicken and egg issue when building data sets. So, wow, it's a little bit hard to read. Right, so a little bit about my industry. The estimate industry has historically been an oligopoly of Bloomberg, FactSet, Thomson, CapIQ. Equity estimates come from about 250 different sell-side banks and brokerages, and the economic estimates come from maybe 60 or 70 different economists per data set. And the other kind of big issues here are that all the data is hidden behind these big paywalls. And not only that, but there are these big permissioning systems. So even if you buy access to a Thomson Reuters IBIS, you still don't have access to all of the individual estimates. So we're talking EPS, revenue, EBITDA, margins, all of the interesting stuff that goes on inside of a company. And these fundamental estimates are used in basically every investment model, no matter your dogma regarding how you like to value an equity or an option or whatever you're trying to do. This is one of the most important data sets to the market at the end of the day. So that model sucks. It's basically 30 years old. It's an enormous business. Thomson Reuters generates about $350 million a year in revenue just off of US equity estimates. Now, some of that is rolled up into the Icon platform. A lot of it is in the IBIS redistribution and direct distribution to the buy side and sell side. We have a better model. So let's say you wanted to allow anybody to contribute to those data sets, buy side, amateur, industry experts, all sorts of different people. You wanted to get rid of the permissioning system completely so that all of the individual estimates are available to be seen. And you're going to validate the quality of those estimates based on statistics, not identity. And when I look at why I started this company, largely, when you look at the financial research space, it's so dependent on identity. We're validating the quality based on identity and not based on accuracy or representativeness or any of these things that you actually want when you look at financial research, specifically structured financial estimate data. And I liken it to what happened with baseball, with Moneyball. In the past, you had all of these scouts who were going out and they sat there and said, wow, that guy has big muscles and a nice swing and a hot girlfriend, and that's why we're going to draft him. And great book, great movie. This is exactly the same thing that goes on in our industry or has gone on historically. And we wanted to change that. And that meant that you validate the quality of the data through the structured nature of the data, the statistics. And what we do is we use a mix of regression and machine learning models to look at the behavior of how people make their estimates, to look at the accuracy of those estimates, to look at all sorts of other characteristics of those estimates so that they can be completely pseudonymous on the platform. They don't have to reveal their identities, which allows them to contribute to a crowdsourced platform. So what does this get us at the end of the day? It gets us a larger sample set. It gets us greater dispersion of estimates. You get less herding because the incentive structures of these analysts are much more aligned towards giving accurate and representative estimates. We get higher accuracy. Our data set, about 70% of the time, is more accurate than the Thomson Reuters or Bloomberg consensus. But most importantly here, it's more representative of the true expectation of the market, which for estimates is really what you're trying to get. You're trying to understand where is my expectation in relation to the expectation of the market or my peers or the most accurate analysts out there historically. And we made it completely free. And that's obviously a big difference between having to go and buy a $1,000 Icon terminal just so you can get some consensus estimates. So how does this thing actually work? This is the platform. Principally, this is really where everything takes place on this page. What you're looking at is the LinkedIn page. This is a 9-quarter representation of LinkedIn's actual reported EPS in green there, the Estimize consensus in blue, the Wall Street consensus in gray, the guidance from the company in red. As you can see, they like to sandbag it pretty good. And my estimates there in purple. And as you can see, there's just this very strong bias from Wall Street to sandbag estimates alongside the company's guidance. That's their job, corporate access and investment banking. It's not to be as accurate as possible. And we can see all sorts of different data viz here. So this is, for me, the most important graph on the platform. This is the scatter plot of EPS by revenue estimates for everybody who's contributed for this specific earnings release for LinkedIn. What I really want to know as a buy-side analyst is where am I, and that's me in the purple dot there, in relation to the distribution? Do I have an outside view? Do I need to act on this? And then here's the other really important graph. This is the change over time in consensus, and we know that stocks behave very highly correlated to the drift, the movement in their consensus estimates over time. So this is actually looking at Apple for this quarter, which will report Monday, I believe. And that's the guidance from Apple there. As you can see, they like to sandbag it too. Here's just some metrics from the company. It's always nice to kind of show the growth. We started the platform in January of 12. As you can see, the unique visitors viewing the data, about 100,000 today per quarter. There's our retention rates on both viewers and contributors. The one that I'm really proudest of here, and kind of the product team that we've built at Estimize, is that one at the bottom right. So what that basically shows is the blue line going up and to the right, the number of estimates per contributor per quarter. And this is really about how do you incent a community in an open way to contribute their very valuable data and then continue to kind of push those buttons and nag people and really do behavioral engineering. And this is what we're really good at as a company. We understand how to do this. So this is just a chart of days to release. So how far in advance do we have consensus? Some academic studies that have been done on our data, a bunch of different ones that have proven a bunch of different stuff. And this is really, these two charts show the drift, basically some of the quant strategies that you can use with the data. This other one as well kind of shows the post-earnings drift, couple of days, the residual returns associated with them. And so how do you make money if you give it all away for free? It's kind of an interesting question, right? So we sell the data. We take all the data and we sell it through an API to large quantitative hedge funds as well as discretionary funds. And we're now building a whole bunch of premium front-end features. If anybody remembers a company called Starmine that got bought by Thomson, very similar to that kind of stuff. And we're building a big recruiting platform on top of it. We've been asked by a bunch of big hedge funds to be able to contact the analysts. So what's next? Just raised a big B round of funding to build out the team. We're hiring a whole bunch of people. So if you or anybody you know would like to come work for an interesting, fun company, please get in touch. And yeah, we have some big biz dev announcements to make coming up real soon. And we've got another data set that we're going to be doing in our back pocket here that I think is going to be really interesting, holding it a little bit close to our chest, but I think it'll destroy stock ratings forever, which I think will be a really good thing. So thank you, appreciate it.